Pinterest had earnings yesterday and the stock is up 12% today. And a lot of people are conflicted as to why the numbers they put out were not so good, yet the stock is still absolutely on fire today. So that's what we're going to go over. We're going to talk about Pinterest, why it's up. We're going to look at the company, what I think it's worth, where I would be buying it, and ultimately if I plan to eventually take a position in Pinterest. Hit the like button, subscribe, check out our Discord community down below. It's completely free. You guys get access to free courses, free live streams, free seminars, free webinars. Hang out in our long-term chat section. I've been over there the past couple of days, breaking down a lot of companies with the team, and we'd love to have you guys as part of our group. So Pinterest climbs on user numbers and Elliott investment, even as financials disappoint. So the actual numbers were not too hot, right? Earnings came in at about 11 cents adjusted versus 18 cents as expected. So not the best. And revenue came in at 666 million versus 667 million, which was expected. So both of those numbers missed. Now, the biggest aspect when you're looking at a lot of these social media companies is basically going to be their users, and it's going to be if their users are climbing and what is their average, revenue that they can pull from a user. That's very, very important. And we saw, Meta come out, wasn't the best. Saw Snapchat come out, really wasn't the best. But the biggest thing is that global monthly active users declined 5% year over year to 433 million. Now, this is one of the things that I'm trying to explain to a lot of people is you can't just look at the numbers. You have to look at what sentiment is. You have to look at what expectations were, and you have to understand the market in which you're investing in. Or if you're trading it, if you're trading this and you're like, I think, 5% year over year drop, why is the stock ripping? Well, you have to realize last year their growth was nuts. And same thing with like growth on Uber, which is another thing we're seeing. Same with growth on like just all these pandemic companies that did really well last year. When you see a 5% decline year over year, normally you're like, that's not a good sign. Like with Intel's revenue decline, I think it was like 18% year over year, 22% year over year. When you see the decline of 5% in Pinterest, most people are like, that's bad. It's not bad because their revenue, their users increased so drastically last year that many people were expecting a much significant drop because they're not going to be able to hold all those users from last year because we had that massive artificial spike due to everybody being trapped in the house. And now that everyone's back out, they're not using these platforms as much. A 5% drop year over year is not bad at all. So that's why, even though it's alarming, the fact that that many eyeballs are staying on the platform is really damn good. And that's why the stock is up, because people were expecting them to lose more users than they had expected. Now, looking at Morningstar, Pinterest and a lot of other analysts have fair value right around $46. And currently right now we are trading 58% lower than that. A 5-star price is 23. And right now we're trading at 20. So it's trading significantly lower than its 5-star value price. Now, you guys probably know by now, looking at this company, I mean, in the social media space, and I've said this for a while, if you watch a lot of the older videos I like Pinterest the best. I think Pinterest has the most amount of room to grow, which is good. And I just like the way that Pinterest sets everything up, from the ability to integrate their ads right into that without it being too abrasive, like a lot of these companies where you just click on it, the ad is there. And I think Pinterest is here to stay. The issue I have is just the fact that they're losing money, right? And the fact that the PE, over the past 5 years, the PE is non-applicable because they just haven't been profitable for that long. And looking at the trailing 12-month PE since they've been profitable, it's really high. So let's just go through and look at some key metrics. Market cap, 14 billion, revenue, 2.67 billion, net income, 322 million. PE for the trailing 12 months is 44.35. Now, the one thing I want you to realize is the reason they were able to become profitable so quick is just because of the pandemic. Now, I'm not saying the company wouldn't have become profitable, but it's a reason why they were able to achieve it very quickly. 5-year PE is not applicable, which is something I do worry about from a long-term investing standpoint. I want to make sure that the company has been able to be profitable most of the time for at least 5 years. Profit margins are 12%. 5-year profit margin is negative 20%, and gross profit margin for the trailing 12 is 79%. Price to sale ratio is 5.53%. Free cash flow is 681 million, and the 5-year free cash flow is 99 million. No dividend, which I don't really care about. This is a growth company. I'm not buying it for the dividend. Looking at the income statement, which is very important, we want to see that revenue is growing. So you can see that revenue is growing very solidly. So if you look, and this is where it gets like just wild to show you the insane amount of growth, which is why, this is one thing I want to say. When you see this much growth, a PE is not of like 44 is not that bad. Company goes from $131 million in revenue in 2018. 2019, which shows you how fast they were growing even before the pandemic, $826 million in revenue. So 5x, 6x in 1 year. 2019 to 2020 to 2020, 1.2 billion. So like 60% revenue growth. 2020 to 2021, $2 billion nearly, so about a 70% growth, and then $2 billion to $2.6 billion in 2022. Very solid growth there as well. And then gross profits, same situation, heavy amount of growth, which is very nice, right? Very, very solid. That's what we want to see here when we're investing in a company like this. And if we just go over quickly and look over on this, it'll be a little bit easier for you guys to see on the financial side. But looking at operating income, finally being profitable in 2021, and then trailing 12 months is 0.24. So really good, right? Really, really good. Net operating income is very, very important, and it's a number that you want to see. And the reason for this, like we said before, is that we want to see, I'm going to go down to net income very briefly here, is that we want to see a company is growing, but we also want to make sure that the company is keeping the cash that they are making. You don't want to see a company that is, growing, which is always nice, of course, but we want to make sure that the company is actually able to hold on to the cash, which they are making. So they are doing that. Net income, they went from losing $52 million a year in 2018 to making $332 million this year. So super solid, exactly what you want to see. Now, let's look at the stock analyzer and let's kind of go over some way that we can find a valuation on this stock and be a good price. Now, the bull and the bear side of things, the good and the bad that I'm looking at. Number one, growth is massive. It's just huge. Number two, they're really doing a good job at net income and holding on to the money that they have, and also holding on to the subscriber base that they've grown in the past 2 years. The bear side is that we don't have enough track record to see if they can stay profitable, and the uncertainty of how many people will stay on the platform in the next year or two is very uncertain. And when you have a lot of uncertainty based around that, I need the price to be like ridiculous. And also projecting future revenue growth is something, to worry about. So let's just look at the last year. Last year's revenue growth was 40%. They grew revenue by 40%. And we have to think of what's an average number over the next 10 years. Let's say that they can grow on the low side revenue by 10%, 20%, say 40% on the high side. And let's do actually 15, 25, 35. I feel like that's more realistic. 15, 25, 35. Now the low side is going to be super conservative. Profit margins were at 12%. So let's say lows 7%, 10%, 12%. Free cash flow right now is at 25.5. Let's say the low percent is 20, 25, 30. PE is 44. Let's say 20, 25, 30, 20, 25, 30. All right, and then we're looking for, I'm just always going to say 15 most of the time. So judging by these numbers, if you think that they can hit the high side, right? I'm going to actually highlight this here. If you think that they can hit the high side here, then anything under $85 long term, like you're solid, right? And at this point right now, we're trading at $22. So if you think they can hit this high side, if you think that they can do 35% revenue growth, they can do 12% profit margins, basically if they can kind of stick to what they're doing right now, then anything under 85 is phenomenal. Now, the mild assumptions, which I think is probably the most realistic, doing 25 revenue per year for the next 10 years, profit margins of 10%, which is a little less than what they're doing now, free cash flow of 25, PE of 25, profit to free cash flow 25. anything under 29 bucks is really good. And then the low side, which I think is very conservative, anything under 8. For me, I if there was a super risky company that I would invest in, it would probably end up being Uber and then maybe Pinterest. If you got Pinterest down around, let's look at Pinterest really quick. If you got Pinterest down around like 10, you're an animal. Like, I'd be holding on to that. For me, it looks like Pinterest can rally from a technical standpoint up to 33, 34. I don't think it's a bad investment, but it's a risky investment. And in order for me to be looking to buy into this company long term, I would really want them down around $10. So what I might do is sell some cash secured puts and then look to maybe enter around 10 or 11. I like the company. I like what they're doing. I just need to see them do it for longer, and I need to feel confident that they can continue to put these numbers up and they can continue to grow at the rate in which they're doing for the next couple of years. So at this point, I am not going into it, but I do think it's a good company.